Hey, welcome everybody to our podcast series on innovative healthcare solutions sponsored by the Conference of Consulting Actuaries. Just for a reminder, if you haven't seen some of our earlier podcast interviews, these are just a series with actuaries and other professionals focused on delivering innovation in healthcare. And I'm sure you'll enjoy this session and all the great sessions we plan to have highlighting the interesting people, products, and services designed to drive a better healthcare system. Now, these sessions are offered to provide insights about what is transpiring in the ever-changing healthcare environment that we're all part of these days. But while these sessions are not necessarily designed to offer continuing education credit for actuaries or other professionals, I'm sure each viewer can assess for themselves if it meets such criteria. Hi, everybody. My name is Ed Pudlowski, and I'm president of Morningstar Actuarial Consulting. I'm also the chair of the healthcare community within the CCA, and I'm going to be your host for today's discussion. I'm really delighted to be joined today by Roy Ramthun. Roy is a nationally recognized expert on healthcare savings accounts and consumer-directed healthcare issues. He led the U.S. Treasury Department's implementation of HSAs after they were enacted into law in 2003. President George W. Bush then tapped Roy to be the healthcare policy advisor at the White House, where he developed the president's approach to expand HSAs while overseeing the implementation of the Medicare prescription drug benefit. You probably know that as the Part B, Medicare Part B. He also served on the staff of the U.S. Senate Committee on Finance and U.S. Healthcare Financing Administration, which you all now know as the Center for Medicare and Medicaid Services, or CMS. And he also spent 8 years with Humana. Roy, thanks for joining us today.
My pleasure. Good to see you.
Hey, Roy, you have a real interesting concept that we want to talk about today on the use of HSAs within the HSA marketplace and coordination of that with the cost sharing reductions that are part of that. So let me ask you this: How did a guy like you, a non-actuary, get involved in so many actuarial concepts like this?
Well, it's probably a good question, and I wasn't planning to do that. But as HSAs became part of the fabric of health benefits in this country, I wanted to make sure that they continued to have a future. And it was less than 10 years after HSAs were created that the Affordable Care Act came along. And there were various proposals, but what we ended up with was these metal tier plans in the state insurance exchanges and a minimum value requirement for employer plans. So right away, we got some actuarial concepts being put into the marketplace. And, I found them pretty fascinating, honestly. So, I wanted to make sure that HSAs could actually survive in that kind of marketplace. Because when I talked to actuaries from various health insurance companies, I was being told that many of those high deductible health plans, which are what are paired with health savings accounts, in some cases had actuarial values below the 60% required to even participate. And so I was like, how is this actually going to work? Are they going to be able to survive? So, I started to ask a lot of questions, and, the implementation didn't come for several years. And in that time, CMS published an actuarial value calculator. So, of course, I had to get out there and kick the tires on that and really understand what it meant, do some modeling on HSA qualified insurance plans, those that have a minimum deductible and an out-of-pocket limit, to make sure that those plans could still be offered. So that was kind of how I got my feet wet in all of this.
Great. Well, why don't you go ahead and give our audience some background around the idea and concept that you've been promoting?
So one of the concerns I've always had with the HSAs and the high deductible health plans, as they're known technically, is there's a fairly rigid structure. And I noticed as we went sort of through this evolutionary process that other plans started raising their deductibles in order to help keep their premium growth down from one year to the next, to the point where today it seems like most of the plans out there are in fact high deductible plans of some sort or another. They don't all meet the technical requirements to be paired with health savings accounts, but I started to look at them and kind of compare the actuarial values of those plans, and I saw that they were quite similar. And I thought, well, why is it that some of these plans can be paired with HSAs and others cannot? Wouldn't it be nice if there was another way to maybe look at eligibility for participation in a health savings account as having a similar actuarial value, some kind of a threshold, maybe at the upper end, we pick a threshold of 80%. So any plan that has more cost sharing for enrollees, on average, less than 80%, the plan is designed to be that, could in fact also be paired with a health savings account. And I wrote a white paper about that and got a lot of very positive feedback. Then, I started to look into other places where that same concept might be used. And this is where I stumbled on the cost sharing reduction plans that are offered to lower income Americans in the state health insurance exchanges. Many of you may not know about some of those details, but I'm happy to go into a little bit more detail on that and what that might be.
Yeah, why don't you go ahead?
So for individuals who have income below 250% of the federal poverty level, they are eligible for what are known as cost sharing reductions. And it essentially works this way. The government gives money to insurers, and then insurers are required to lower the cost sharing amounts, that being deductibles and out-of-pocket limits, in some cases, their co-pays, so that the actuarial value of those plans increases from the standard 70% actuarial value required for a silver plan to higher levels, as high as 94% for the lowest income group. And when I started looking at those options, I realized that a lot of silver plans are in fact HSA qualified. They meet the requirements that the IRS has set forward. But the minute that a cost sharing reduction is applied to those base silver plans, I have not been able to find any HSA qualified cost sharing reduction options available. So that was kind of like my next area of focus. Could there be HSA qualified plans available to these lower income individuals? What in fact might be the availability of an HSA contribution as part of that plan design, instead of reducing the deductibles, reducing the out-of-pocket limit? Because I'm thinking, there could be a lot of younger, healthier people out there who don't actually use a lot of healthcare, but may not feel that they get a lot of value out of the cost sharing reductions as they're currently designed. So that's kind of what got me interested in looking into this topic further.
Right. So maybe maybe can you provide our audience an example of, kind of how that might work?
Sure. So let me just say a couple other things that I think also weighed into my decision here. The first is that I've observed a trend in the marketplace of moving to many narrower network plans. It used to be back in 2014, when these marketplaces first went live, that PPO and point of service plans were the dominant plans. They were about 56% of the plan offerings available. Fast forward now to 2021, the last year that we have this data available for, it's over 80%. So if you're participating in the cost sharing reduction market, a lot of times, you only have a narrow network plan available to you. And, one of the beauties of the actuarial value calculator are there's some tables in there where you can look at the claims distribution under each of these different types of plan options. And, I observed that a lot of people have no claims, about 16%. About half of the people have claims below $1,000, and over 60% have claims below $2,000, and that's the combined medical and pharmacy claims distribution for a silver plan, which is where the bulk of the enrollment is. So I thought if we could substitute some of the cost sharing reductions with an HSA contribution, this might be something attractive to people that don't have a lot of healthcare expenses, that they could actually build up some medical equity over time and use those dollars in the future for years when they do have more expenses, or maybe to cover things that their health plan might not cover, such as dental, vision, hearing, etc. So I started doing some modeling, and on this slide here, I'm only going to show you one of the slides that's available in the white paper that I've co-authored. But this is the middle income group of the three. And on the left-hand side under table 6, you can see that in order to have an HSA qualified plan that meets the actuarial value requirement of between 86 to 88%, we're at the very low end of the deductible range for HSA qualified plans. In 2022, the minimum deductible for self-only coverage is $1,400. So it's possible to design an HSA qualified plan with the minimum deductible of $1,400 and no coinsurance, meaning that once you hit your $1,400 deductible, the plan has to cover 100% of your remaining expenses for covered benefits. Now that puts you at the upper end of the actuarial value range, just under 88%. You could also design plans with slightly higher deductibles, but not any higher than about $1,700 under that 0% coinsurance option, because that puts you down at the bottom end of the range around 86%. Now, one of the other requirements for this income group is that the out-of-pocket limit for any plan participating in cost-sharing reductions would not be able to exceed $2,900. Well, when you put that factor into the actuarial value calculator, it's almost impossible. In fact, I believe it is impossible to design a plan that would have a deductible high enough, if there's any coinsurance involved, in order to meet the requirements for actuarial value. So then in table 7, I tried to come up with similar looking plans, but I also tried to then factor in an HSA contribution, which the actuarial value calculator allows you to do, come up with plans with similar actuarial values, similar look in terms of plan design. So plan 1 and plan 2, you meet your deductible, you have 100% coverage after that point. And plans 3 and 4, lower deductibles, but 20% coinsurance after the deductible. But my goal here was to try to find what would the maximum possible HSA contribution as part of the benefit offered by the plan, what could that be and still be within the actuarial value range. And honestly, I was surprised by the numbers that the calculator produced. I didn't expect them to be this high, but it is what the actuarial value calculator produced. So we can all debate about, are the merits of the actuarial value calculator even intended to accommodate, kind of cash contributions to HSAs or not. But I'm just trying to explain, this is what the actuarial value calculator appears to allow. And in fact, you could actually have HSA qualified plans that would meet the same actuarial value requirements as the cost sharing reduction plans on the left side in table 6. So I'm not going to show other slides that you can see in the white paper that I co-authored, but the cost sharing reduction scenarios are also provided in that paper for the income group just below this one, which was 150% to 200% of the federal poverty level. So the next lower group is 100% to 150%. The higher group is 200% to 250%. I'm not going to show any additional slides here, but I will say that similar modeling shows that for the lower income group, between 100 to 150%, the actuarial value obviously has to be higher. So your plan designs look very similar, but the HSA contributions are much higher, driving the actuarial value up to that higher range, on average 94%. And I found that some of the plans could actually have a contribution to the HSA equivalent to their deductible. So you could actually design a plan that fully covered somebody's deductible, which I thought was quite astonishing. I'll just give one of those numbers. For example, a $4,300 deductible plan with 20% coinsurance, out-of-pocket limit at the maximum allowed for HSAs of $7,050 could have a $4,300 HSA contribution equal to that policy deductible. So that's gotten me very excited as with my co-authors on this white paper that we've written. So you can stop sharing this slide now. I think I've beat that point to death a little bit. But I'm not aware of any other rules which preclude these type of options from being offered. But I do think it's important for me to cover a few other concepts of how this might work before we get too far into other topics. But let me stop, Ed, and see if you wanted to probe a little bit further on anything I've just mentioned.
No, I appreciate everything you shared, and I think you've probably hit on a note with many of the actuaries listening in on this broadcast about the value, if you will, about the actual value calculator that's out there. I'm sure there can be a lot of opinions about that. But I think it would be important for you to maybe talk about some of the other features that you were considering putting into play in this type of product, particularly, how often it would be funded, what vehicle would you use around these, because I'm sure there's a lot of questions that are being generated around that.
Right. So my co-authors and I, we're also debating this concept in the context of a larger discussion, which some of you may have heard, related concepts called silver loading, which all comes back to the fact that the government no longer actually pays insurers directly through a government appropriation to provide these cost sharing reductions. So insurers found that they could redesign their plans and increase the premiums in such a way that the premium tax credits, which are the other subsidies based on income look focused on just the premium side, flow through the federal treasury into the health plan to cover the higher expenses of, administering these programs, as well as providing greater, richer benefits to individuals who sign up for them. So my co-authors were very concerned about some of the budgetary issues related to this backdrop of government funding, and do not feel that silver loading is the way that we should be doing it. In fact, they point to a Congressional Budget Office report that said that the cost to the federal treasury is like $40 billion higher per year under silver loading than if the government just directly appropriated the money to the insurance plans. So we're kind of living within that context as a backdrop of this as well, and applied some thinking to how we would want this to work. So what we recommend in the paper is that insurance enrollees in the state insurance exchanges be offered an HSA qualified plan option as a choice in lieu of the cost sharing reduction plans as they are currently known and administered. So we want to make sure that there's choices in the marketplace, and we agreed in the paper to require carriers to offer those plans as an option, kind of like the direction that CMS is going with standardized plan options. So, if you want to offer anything else, you have to offer a standardized plan. Well, we want to make sure that HSA plans are available to enrollees. So we came down on the side of requiring carriers to offer them. Now, I talked about some fairly sizable HSA contributions, and I'm sure that those who understand how HSAs work, if that meant that the government, gave money to the insurance company that they expected to pass along to the enrollees in the form of an HSA contribution, that's cash out the door. And if you had to put all of that money into an HSA on day one, some people are not going to be with you on day 2 or 3 or month 6 or 7. So, I understand these are lower income individuals. We would like them to have money available in case they do, in fact, have out-of-pocket expenses that they need to pay. So if you have a $2,000 expense, yes, it would be nice to be able to get the $2,000 from the HSA to cover that expense in January. But for now, we recommend that those contributions be made monthly on a prorated basis. So if somebody is enrolled in your plan for 3 months, they only get 3 months of the 12-month value of the HSA contribution that is part of the plan design. Any money from that point on could accumulate as long as it's not spent, and would be available to them to use. But we also put one more governor on the use of the funds, because most people who have HSAs today are legally able to use their HSA funds for things other than healthcare expenses. There is a tax penalty, but for low-income folks, the tax penalty might be negligible to them, and they may not care as much. It's, hey, I've got the money, I want to spend it on this, and so they decide to make a withdrawal to spend the money on that. To avoid the possibility of that, we would essentially require that they only be able to access the funds through an IRS-approved debit card that restricts their eligible expenses that they could spend the money in their account on using that debit card. So they wouldn't be able to withdraw cash. They wouldn't be able to spend it on anything that the debit card would not authorize. And in that perspective, the debit cards would work a lot like the debit cards that are with healthcare flexible spending accounts or health reimbursement arrangements. Because it's in those cases the employer's money, not the enrollee's money. But we had to strike a balance between giving value to the enrollee, but making sure that the taxpayer's interest is also protected and that it's limited to be used for truly IRS eligible health expenses. So those are the other features in that you'll see in the paper that go along with the plan designs. The plan designs are what I care about. That was my major contribution to the paper, and we work together on these other features as well. So I hope people go to the website and read the paper and provide feedback to us. We would love that input.
Yeah, Roy, I want to thank you. I think I've got a lot more questions, but we're approaching the end of our time here. So I really do want to thank you. And as Roy mentioned, for those of you who are watching this here, more information and details on the concept that Roy has discussed is available via a white paper that's going to be that Roy co-authored, and it's going to be available on our website at ccactuaries.org. So please look for that as it's a wealth of information, both to the actuary and non-actuaries in the audience. I'd also like to mention too that Roy is going to be speaking at the CCA annual meeting in October in Austin, Texas, on the topic of individual contribution HRAs. But I'm hoping that we might be able to find another platform while he's there to tap into some of these concepts with him. So if you haven't signed up as yet, please consider doing so. Make sure you secure your spot and hotel accommodations. There's a lot going on in Austin in October, so I encourage you to do that quickly. I'd also like to encourage our viewers who also participate in our healthcare community to continue any discussions about the insights shared here on that platform. If you're not a member of the CCA, you might want to consider joining to not only experience the benefit of community platforms of the CCA for these types of informal discussions, but also the great benefits that our members enjoy. Roy, thanks again for being here today and sharing your insights. I'm sure our audience benefited from the time you spent with us, because I know I thoroughly enjoyed it.
Thank you for the opportunity.